If you're a resident of Canada, you'll be taxed on your worldwide income. But what a lot of Canadians don't realize is that not every country does that. Some of them only tax what you earn locally, and a handful don't tax income at all. And that's why many of our clients who are receiving pensions or doing remote work or running businesses abroad are saving a fortune by making the right move. And in this video, I'll walk you through the three main types of tax systems Canadians are using overseas, from zero tax countries to territorial tax systems and then remittance-based tax systems. And stick around to the end because I'll also show you the biggest CRA traps you need to avoid for taxes. Let's start with the most extreme option, countries that don't want a single penny of your personal income. Let's go across the globe to the Middle East, where oil money means tax freedom. We can start with the big guns, the UAE. Whether you're in Dubai's glittering towers or Abu Dhabi's business districts, your personal income stays in your pocket. Sure, they introduced a 9% corporate tax rate in 2023, but that's only on business profits above about $140,000 Canadian. Your salary and your personal income, though, is completely untouched. So meet Mel, a Canadian remote worker. She moved to Dubai thinking her $120,000 income would suddenly be tax-free. But because she was still on a Canadian payroll, the CRA kept withholding 15% according to the tax treaty with Dubai and Canada. Her salary was considered Canadian income. So she restructured. Mel set up a small company in Dubai, and instead of paying herself as an employee, her Canadian employer started paying invoices to that company, and now the income counts as UAE sourced, not Canadian. Canada won't tax it, and Dubai doesn't tax personal income either. But wait a minute, this is not as easy as it sounds. There is some real risk here. The CRA could look at your setup and decide that it's a personal services business. That means they see you as a disguised employee, which wipes out the tax advantages and could get you hit with a reassessment and penalties, even as a non-resident. Mel's strategy, though, worked only because her company was structured as a legitimate independent business. She had to change her legal and professional relationship with her former employer in a way that the CRA could recognize. And that process can get very complicated, which is why the right professional advice is so important for doing a strategy like this. Qatar and Kuwait are playing the same game. Qatar operates without any personal income tax whatsoever, and Kuwait joins the exclusive club with countries with zero personal income tax. I think these countries figure if they're sitting on so much oil wealth, why bother taxing people's paychecks? Then there's European luxuries. Monaco, for example, is a playground for the ultra wealthy for good reason. There's zero personal income tax for its residents. The catch, though, you'll have to pay through the nose for everything else. And we're talking about one of the world's most expensive places to live, but if you could afford Monaco, the tax savings might make it worthwhile. Caribbean, your offshore tax havens. The Bahamas, Bermuda, and Cayman Islands offer the classic offshore experience. Zero income tax across the board. The reality check, though, is these places typically require some serious investment to get residency. We're talking hundreds of thousands or millions in real estate or business investments. And there's always the risk that rules will change in the future. There's also places off the coast of Australia, such as Vanuatu. And this specific island nation gives you zero income tax, zero capital gains tax, and zero inheritance tax. And even better, they offer one of the world's fastest citizenship by investment programs, and you could literally buy a passport that comes with permanent tax freedom. So how does this apply if you're Canadian? Well, once you've properly left Canada's tax system, you could collect a pension in one of these countries, run a remote business, or even establish a corporation, and potentially pay zero income tax. But zero tax countries are also quite limited in choice, and it can be quite expensive to access, which is why the next section opens up way more options. But before moving on, if you're thinking about leaving Canada, make sure you're not missing any key steps. I put together a free guide on the 7 biggest CRA tax traps Canadians face when moving abroad, and you can grab it at the link below. Countries with territorial tax systems. Paying Canadian tax on money that you earned overseas can often feel like a big ripoff. And the good news is, though, you don't have to. In countries with territorial tax systems, you're only taxed on what you earn inside their borders, and your foreign income stays untouched. Imagine this. Say you set up a consulting business while living abroad. Your clients are in maybe Canada, the US, and Europe, and all your revenue comes from outside the country where you live. And because you live in a territorial tax system, none of that foreign income is taxed locally. You can still enjoy residency, access local benefits, and build your lifestyle while keeping every penny of your offshore income. And that's the power of territorial taxation. Hong Kong is the gold standard here for territorial tax systems because they won't touch your foreign income. Other countries such as Malaysia, though, it's a bit more complex. Right now, foreign income is exempt until 2026, but they've been debating whether to extend, phase it out, or fully tax it. And that uncertainty makes Malaysia perhaps attractive in the short term, but risky if you're trying to build a 10 or 20-year plan. And if you want something closer to home, there's Panama and Costa Rica, which both say, keep your foreign money, we don't want it. They have relied on this system for decades to attract expats and investment. If you're an entrepreneur, Georgia, that's the country, not the state, has a 1% tax rate, which is essentially zero. And many of these aren't just loopholes or temporary tricks. Countries like Paraguay and Uruguay have seemingly built their entire tax systems this way because they want to attract more people like you. And the question isn't whether this works, it's which option fits your life best. Territorial tax countries, I think, is where the real strategies start to open up, from structuring a business abroad, to managing pensions, to coordinating residency between countries. This section offers the most opportunities for Canadians to reduce taxes. But it's also where one wrong move can be quite costly. And here at Blueprint, we've helped Canadians legally lower their tax burden while building wealth overseas. These strategies can be very powerful, but they require careful planning. So if you're ready to explore your options properly, you can book a discovery call with our team and build the life you want with the right blueprint. Now let's look at remittance-based tax systems, which work differently from the worldwide tax model Canadians are used to. Now, instead of taxing all your global income, these countries only tax foreign income when it's remitted or brought into the country. The best known example used to be the UK's non-domicile regime, which let wealthy expats keep foreign income offshore tax-free, as long as it wasn't transferred into Britain. But that all changed in April of 2025, so very recently, when the UK scrapped this system and moved to a residence-based model. Now, new arrivals get only a 4-year exemption on foreign income before being taxed worldwide. Thailand is an interesting case because in the very recent past, it stated it had a remittance-based system. So as long as you didn't bring in income that you earned within a year of earning it, it wouldn't have been taxed in Thailand. But as of 2024, they changed that. But there's been a lot of pushback with that rule, so we're monitoring the situation closely to see whether it will be enforced or reversed. Malta, Cyprus, and Ireland, they still operate on remittance or non-dom regimes to attract expats. Then there's Japan, where their new residents are non-permanent for 5 years and foreign income is only taxed if remitted. And after 5 years though, worldwide income applies. Singapore is a bit of a strange case. It's technically a territorial tax country, but with remittance-style features. Because by default, foreign income is taxable if you bring it into Singapore, but in practice, there are so many exemptions. For example, income already taxed abroad or certain types of foreign source dividends, where it ends up that most expats never actually pay that much tax on remitted money. And this makes Singapore look a lot like a remittance system, but it's not structured the same way as the UK or Malta. For Canadians who've properly left the CRA's tax net, remittance systems can create a lot of opportunities, keeping pensions or business profits offshore, only bringing in what you need and lowering your overall tax bill. But as the UK and Thailand examples have shown, rules can change quickly, so it needs to be under constant review. But hold on, let's talk about some reality checks. Before you start packing your bags, there are some serious gotchas that you need to know. I'm not trying to scare you off, but the wrong move can cost you quite a lot. As Sun Tzu said, every battle is won before it's fought, and international tax planning is the same. Preparation is everything, and your enemy is the CRA. For Canadians, that starts with severing residential ties, things like your home, spouse or dependents, local bank accounts, and memberships. You'll also need to file a departure tax to confirm that you're a non-resident with the CRA. Canada's exit tax is another hurdle. When you leave, the CRA treats most assets as if you sold them at fair market value, and it can create a pretty big one-time capital gains bill before you are even gone. And then there's something called the CFC rules. Even if you move abroad, Canada might still tax income from a foreign corporation that you control. Under the Foreign Accrual Property Income, or the FAPI rules, if your company earns some passive income like interest, dividends, or rents, the CRA could potentially tax it immediately even if you don't bring the money home. Don't overlook visas and residency permits as well. Some countries require large investments, others demand proof of income, and many have long application processes. And finally, there's the lifestyle reality check. Monaco, for example, might be tax-free, but everyday costs are sky high. On the flip side, some developing nations might be cheap, but you might be trading off some things like nice infrastructure or reliable internet or quality healthcare. And finally, there's the political risks. Just ask anyone who had UK's non-dom status. Tax laws can change quite rapidly, and suddenly your perfect setup is kind of worthless. The point is, while this stuff works, you better do it right and be prepared to be flexible with your strategies as well. Because taxes don't have to chain you down. The key is knowing the systems, territorial, zero tax, or remittance, and using them the right way. And here at Blueprint Financial, we turn complex global tax planning into clear step-by-step strategies so you can keep more of your money and live the life that you want. So check out our website to see our services. And here's another video on the screen that I think that you'll like. So go ahead and check it out here.